The question is, why don't people trade more?
It's about the breadth of the market. In equities, you have thousands and thousands of instruments.
You need to take care of, mergers and acquisitions, all the corporate events, a lot more little components where futures market is always the same. It's much easier to tell a story. I feel like the equity world is always a bullish world. In macro, it's a bit more fixed income and stuff like this. It tends to be a very bearish world.
I would say neutral.
It should be. But they're always waiting as some catastrophe coming, where the equity, always bullish.
It seems like starting a futures trading business is a very easy exercise.
I didn't say this. You want to buy a decent, not too small, decent portion and forget about it. That's what you want to do with managed futures.
It seems like you are asking for a crisis.
No, definitely not.
Hello and welcome, it's Capital Horizons. I am Igor Yelnik. My guest today is Tom Ducrot, founder of Ratio Futures. Hello Tom, good to have you on the show.
Thank you very much for having me, Igor. Good to see you.
Good to see you. We're going to discuss the managed futures market today. And the first question is a very generic question. Why do people even try to trade there? Why do people even try to extract alpha in those markets when there are way more rich markets like the equity markets, for example, where you have thousands and thousands of different instruments, whereby in the futures market you only have maybe like 100 or so liquid contracts?
Well, I would go from the other side of that question, which is why don't people, invest more in the space and trade more in the space? Because it brings so many qualities to a portfolio in terms of diversification, liquidity. It's easy to access. You mentioned it's 100 markets, but it's very easy to trade. I was actually talking yesterday to this Singapore Futures Exchange, and they do everything deliverable in dollars and very easy to access. So the question is, why don't people trade more? And if you think about it, we're back to being about managed futures is about 10% now, or hedge fund assets. And that's about what we had back in 06. And if you take the long-term trend, it's about 18-20%. So I think people are massively underallocated in the space. That's number one. The second, if you look at it from a manager's, why do managers trade? Because again, it's liquid. It's always the same. It's the same contract, that rolls and stuff like this. In equities, you need to take care of, mergers and acquisitions. You need to, all the corporate events, dividends, and stuff like this. And so it's a different job. It requires, a lot more little components, where futures market is kind of always the same. Does that answer your question?
Well, not exactly. First of all,
Okay.
in futures market, you also have some issues. You need to roll the contracts because they tend to expire unless of course, you trade perpetual futures. And nevertheless, it's about the breadth of the market. In equities, you have thousands and thousands of instruments. So
In
your
futures, a lot
potential
less.
breadth, huh? In futures,
In futures, a lot less.
yeah, of course. So the breadth affects the possibility to extract alpha, and obviously the set of opportunities is richer in equities.
First, is it all about just pure alpha? Question number one, because again, trading in futures market brings you a lot more than just alpha. The second is when you look, when you take away, the top equities and stuff like this, liquidity becomes, very scarce. And especially during the day. So open and close, there's a lot of trading, but during the day, there's a lot less. So it's still an issue. But also have in mind one thing, the cost. And data is extremely expensive. Futures data, again, because it's always the same contract that rolls, is pretty easy. But you go into equity data, and there's a lot more you need to gather, and so the infrastructure cost is extremely high. So starting today, a systematic equity manager is extremely challenging from an infrastructure standpoint, and that's why they all go to the multi-strats. Is because your threshold to be profitable as a manager is a lot higher. The cost of data, the cost of maintaining all this.
Okay, it seems like starting a futures trading business is a very easy exercise. Uh,
I didn't say this. Nothing's easy. Everything is it's hard work. Uh, but in that specific case of of data and stuff like this, it's a little bit less complex. Yes,
okay, now how about the use of capital? Uh,
efficiency.
it's obviously way more efficient in the futures market, right?
Yes. You just put up the margin, whatever, whether the broker is asking for minimum margin, twice the margin, stuff like that. It depends on the broker. Extremely efficient. On top of that, if you want to put the full cash, you can put the full cash and all, and now kind of earn interest on it, which for many years was not the case. In equities, you need to borrow from the broker. That's why you have the prime brokers, to be able to get some leverage. And by the way, in the equities, you tend to look for idiosyncratic alpha, just a residual, and it's pretty small, and therefore you need to put a lot of leverage to be able to show some performance. So there's a lot of risk involved there that I think people misunderstand or are not very aware. Where in futures, I mean, it's pretty well oiled. It's a very well-oiled machine from that standpoint. Your margin, your maintenance margin, and blah blah blah, and your broker calling you saying you have a margin call, and then you wire someone money. It's pretty well done, and therefore, because you only need to post that margin, you can get a sizable exposure for very little cash, and so it's extremely convenient from an efficiency standpoint.
Yeah, and we are a systematic macro manager, and
Hmm.
we think about the world in macro terms. To me, futures are a way to very conveniently express macro views, and
Hmm.
it doesn't really matter whether these views are formed by a discretionary forecast, by a discretionary manager, or by a systematic manager. It's just way more convenient to think about the markets rather than about individual companies. However, of course, you can think about the markets and the countries, which is way more convenient for me. But for other people, it's not the case, right? Because they still prefer to think about companies, about industries, about sectors, value versus growth, and there are practically no futures for that.
Yes. And on top of that, it's much easier to tell a story, which people love in this business is telling story. And in the equity world, you have thousands, like you said, of examples of stories you can tell. Where in futures, there is some storytelling component if you're a discretionary guy, but my view of looking at futures investing and managed futures in general is when macro meets engineering. Is it can be very technical on macro data. It's all about your how do you size, how do you do your risk management, where your signals, and so there, even if you're a discretionary guy, that component is still very important. And right now, a lot of the guys use um technical, or they have their models, even if they end up doing a discretionary strategy. And so there's a lot less storytelling from that you can get in the equity world. And by the way, I think people should be in both. Um, I think right now people are underallocated in the futures world, and maybe somewhat overallocated to the equity world. But that might change with the markets these days. Also, I'll tell you a funny thing, because I had a very interesting lunch with a long-term manager this week. I feel like the equity world is always a bullish world. People always look up, next growth, the new invention, so we had AI for a while, blah, blah, blah. In macro, it's a bit more fixed income and stuff like this. Tends to be a very bearish world. And so the systematic guy doesn't care. He's going to get long, but he's going to get long or short of so many different things that is not, he's going to be fairly uncorrelated to the equity market. But the discretionary guy tends to be, the macro guys tend to be very bearish, very often.
I would, I would, I
Many,
would, I would say neutral.
they should
You,
be.
you, you,
They
you,
should be. but they're always looking from a macro angle of waiting as some catastrophe coming, in a country or this or that. Where the equity, I mean, always bullish. It's like
Yes.
someone said recently, the equity asset class is the hope asset. Uh, which I thought was extremely telling. Um, and the fixed income and the more macro tends to be a lot more bearish, I feel, which is good. They complement each other very well.
Yeah, with regards to the hope market, it's quite an interesting name. And it's actually quite perplexing, I would say, that people tend to forget about very long periods of underperformance of the equity markets. The market has indeed been like a raging bull market in the recent years, but we can remember very long periods of underperformance. In the US, I think the longest period was between the Great Depression of 1929 and the market recovered in 1954, if I remember correctly, like 25 years. Japan was the most recent example where it took over 30 years, like
Mhm.
34 years, to the market for the market to recover. However, the general impression is that this equity risk premium is going to move the market and the market prices up all the time.
Is it?
And therefore, people feel so comfortable investing in stocks, and they go into private equity where they lose access to their capital for years and years and years, and there is no possibility to exit. And this is how the market thinks.
Absolutely. And I mean, talk about private equity and right now private credit, which is a big thing that, for many years, people were investing in, and now you're seeing cracks everywhere and stuff like this. Why don't people come more to managed futures? That's the whole purpose. It should be your diversification. It should, it has a positive, expected return, and you do have some great years, and some years are not as good. But what you see is what you get. Private equity, you never know what you're getting. I mean, for me, it's long equities. It's illiquid long equities with a lag. Because the time that they're repriced generally is, 6 months, at best, and generally a year before they reprice their private equity stuff when the equity market goes down. So, I agree. We should have a lot more in the in futures, but that's why also equities has attracted so much assets, and why everyone trades it, because everyone looks at the bullish periods that can be long, and the last one has was fairly long, and they're like, well, what is it if you lose 20%? Over time, we know it's going to be very, it's going to perform.
Yeah.
It's unfortunate.
Well, that's the fact of life.
Yeah.
When we're speaking about people making money in the futures market, how do they do that? I mean, we manage systematic macro fund. We know how we make money out of it. In general, how do people make money in the futures markets?
So it's funny, very often people see managed futures or the futures market as a zero sum gain, because since you have your wins and losses every day, someone has lost if you make money. The I disagree, because some people have a genuine interest in being, longer shorter contract, even if they lose a little bit in the short term. But for me, there's basically three categories of managers in the space. There is, people like yourself who are systematic and they're looking to build models, whether it's, price-based models or, fundamental-based models with fundamental data. Then you have your discretionary macro guy that tends to be very top down, looking at the world and stuff like this. And third, you have your more discretionary commodities that tends to be somewhat bottom up. They have their weatherman, they have, all this, and they're looking at the crops and this specific. So those are three very different types of strategies without counting all the different sub strategies. You're in one of those little buckets, but there are other buckets as as big or bigger than yours from that standpoint, where you can extract alpha, and that's the beauty of it. Is I think that we have all those ingredients that you guys all share. The recipes are very different from a manager to the other, even in the systematic world. That's why you see the dispersion of returns, even within a single category of managers. Not all trend followers do well when trend following is doing well. It depends, how, it depends on your asset allocation in terms of markets. It depends on your risk management and your portfolio construction and your alpha. So basically, the building of the model is not a tiny, but it's a component of your outcome. And it's the same thing for the discretionary guys. If you think about it, generally you have 2 to 3 big themes every year where you make money. Some are going to hit the three and they're going to make a lot of money, and some are going to hit maybe one, and maybe they're going to have something themes wrong and they're going to lose money. And so there's always a big dispersion of return. So many different ways of extracting alpha in those markets, and different styles for that matter.
Okay, but for investors, what's the benefit of having managed futures in their portfolios?
So first, we say manage futures, which means I think you need to have several managers in your portfolio with different approaches. Because then, you put some managers who are not very correlated, or even so uncorrelated, and that will smooth out your return curve, and give you diversification within the managed future space, and help you make money from that standpoint. That's one thing. Again, as I said, I think you need to, and therefore you need to pick managers in those three buckets, in the systematic bucket, and there you can go, with one long-term trend follower, one midterm, one short-term, some pattern recognition, some AI managers, people that have very different approaches. You go with your discretionary guy, your source of the world, and Caxton, and all those big names, or Graham, and there are many others and newer ones as well. And there, some can be specialized in a geography. Generally, they're going to be either G7. Some are going to be more Asia focused. Some are going to be a bit more, more Brazil focused. There's quite a few discretionary macro managers down in Brazil, and there, you can also kind of get some diversification there. And then you're going to have your commodity. We used to have a period of time in the commodity world where we had a lot of managers trading all the markets, and then they all went out of business when the prop desk at banks disappeared, because basically their edge was getting the information from where the flows were, from calling their former buddies at banks, and that went away. All the managers shut down. Nobody was investing in the commodity asset class, discretionary, and then it's coming back, but more with specialists. You got your nat gas trader, your cotton trader, your ags or metals traders and stuff like this. So it tends to be very niche from that standpoint. And there, you need to, selecting your managers, you need to do your due diligence. It's very funny. I feel like in the space, hedge fund space in general, people have a very bottoms up approach to due diligence. Is whoever contacts them, they're going to analyze. I tend to have a very macro, especially in our world where it's a very defined um, space. You can basically get 90% of the names very easily, and then from there, you can do a quant analysis on their track record, and then look at the pedigree, the strategy, the infrastructure, and all this before making a decision. But it's funny how, again, people tend to have a very bottoms up approach, and where I think that we should have a very top down approach to investing in the space.
Okay, so the benefits are clear. So who are the investors who actually puts money into these strategies?
So the investors, actually, you have not a lot, but you have in pretty much all the categories. The pensions, after a wait, finally got to investing in the space. Chunky tickets, negotiate their fees, quite a bit. Um, uh, the sovereigns, ADIA has been in the managed future space forever. They've allocated billions and billions of dollars to the space, and are still a big fan. Your fund of fund, and you even have, fund of funds who are specialized in managed futures, like Efficient, like Abbey, and others like this. And Morgan Stanley has a very dedicated managed futures program that's been around for many years, that they had combined with Citibank's managed futures program as well back in when was it in 2010 or something like this, and that was several billion at the time. And then you had your fund of funds slash private banks, the LGTs of the world. They've always been in the space as well. And then you have your family offices, and family offices. You see a lot of family offices who are a little bit like the gold bugs. They love, some of them love managed futures, and so they're always allocated to it. They make fortunes in it. They trade in and out. They rotate their managers. They start early with some managers, and therefore they negotiate fees in exchange. And these have been a good breadth of investor styling in the space. We've seen quite some success. I feel like, a lot of the endowments are still lagging in that space massively. What has changed in the industry as well from an investor standpoint is back in oh 02, oh 03, oh 04, you had a lot of investors that, whether it was your fund of fund or even some private bank stuff like this, that could give $20 million to a guy, that had a short track record and be call it 50% of their assets. And so you could start a fund, and all that has compressed to now, only allocated to big ones and negotiating fees massively. A lot of the trend followers, for example, you see flat fee, um, fairly low flat fee, and no performance fee. In the discretionary macro world, it tends, there's negotiation, but there's still both management and performance fees. And the ones that can protect even more their fees is probably the commodity guys because of capacity issues. So they'll turn down a lot of tickets that have when they have very limited capacity. So investors again, we don't have from almost all segments. It's just that it's always a few in each segment that allocate to the space. And now, by the way, if I may finish on this, hopefully the retail people will get into it now that you have a lot. You have quite a few ETFs that offer managed futures. Bundled in a ETF, and that I think could potentially raises some assets for managers. The challenge there is going to be kind of explaining the strategy for sure.
Okay, I have so many questions on what you have
Hmm.
just said. And let's start with investors who are underrepresented. You mentioned
Yes.
endowments, but also there are some pension funds who still sit with their traditional 60/40 allocation, and this 60% equity portion includes some money invested into private equity, which is the money locked for several years, up to 10 years sometimes. There are foundations which are also, I would say, underrepresented in this market. What do you think the reason for them to be underrepresented? Are they not seeing the benefits that we have discussed?
Um, no, I think a few things. First, with the pensions, you have a lot of a lot go through consultants, and even though we got consultants somewhat converted into doing managed futures, they generally pick one manager and that's their go-to managers. And if they have a marginal dollar to allocate to the space, they will go to that manager. And there's not a lot of rotation of managers. It's always a tiny, tiny little part. Um, it's and for the foundations and the endowments, as you said, there's a big private equity exposure and lack of cash. But again, with margin efficiency, that shouldn't be such an excuse. I think it's where they came from. In futures, now we have a lot of math PhDs, but for a long time it was really a trading background coming from the pit, not well educated. The equity world was always, very aristocratic, or even the fixed income was a very technical. You need to know math, and so it would attract, the grads of the best universities to a certain extent. And so I think there's a lot of that in the end. Is you know I don't come across a lot of, Ivy League, MBAs, in the futures world, they tend to be at, some equity hedge funds or foundations, stuff like this. And so there's a little bit of that. I don't think it's the main reason, but I think there's a little bit of that. Is futures tend to be a more cowboy style, it was the agricultural people hedging their crops and stuff like this. And so that's a little reason as to why they're underallocated is in the end, I think it's lumpy returns. It's a low Sharpe ratio, and so they favor higher Sharpe ratio or a little bit more guaranteed, and they'll go with the crowd. Um, and that plays a lot into their allocation. When you go to your boss at the investment committee level and you say, here's a manager, zero correlation, but you have a expected return of 10% and a vol of 15-20, and they had a drawdown about 15-20 that was not so long ago. Good luck getting that, that approval at the investment committee level. It's better to be with the crowd, all the other pensions, all the other foundations and endowments doing the same if investing in equities, and it's something that we know, and an expected ratio that is higher. Why? Because we understand the story. We don't like the black box. I think the black box is the brain, someone's brain. But I think it's all those little reasons as to why, in the end, those confirmed by the consultants that, again, don't push the space much. It's I think all this is what you get under allocated. And if we zoom out of the systematic guys and we go into the discretionary guys, it's somewhat the same. The macro guys can be, can have pretty lumpy returns and stuff like this. So again, the equity market goes up. So you're going to have some beat embedded into it because people are generally not market neutral. The equity guys are generally, 50, 40 to 80% net long. So no matter what, you're going with the tide. Easier to be wrong in that context than being wrong with futures.
All right. So you're saying that the asset management game for institutional investors is basically a relative return game. It's not about absolute return.
Mhm.
You have to follow the crowd, because if you don't follow the crowd, you may all of a sudden happen to produce worse returns than everyone else, and this is your career risk.
Yes. There's some of that. Another analogy I could give you, which I like, is if you have a house, that's your portfolio. Okay, equities are in the living room. Bonds are the bedroom. What's managed futures? It's a fire extinguisher, and so it's and so the problem with that is that people won't invest in it only after the house burned down. So if your house hasn't burned down for 10 years, people forget to replace the fire extinguisher, even get rid of it. That's exactly what's happening with managed futures now. We're back to 6% of hedge fund assets, which is what we had in '06. And, and back in 2010, we're back to about 18% of the hedge fund industries, and the managed futures AUM had doubled from '06. There you go.
Okay, okay. This is a good analogy. Now, you mentioned ETFs, which are packaged in managed future strategies, and we know that there are other wrappers around pure managed future strategies, like 40 Act funds, UCITS fund in Europe. There are some platforms where people trade their managed futures programs. So what's the benefit of those? Don't you think that these are just additional costs which investors have to incur?
There is with the cons, there's generally some strong benefits that can come, and so it's basically it's a trade off. The managed account, easiest route. Very low cost, none actually. But then you need to do your accounting to a certain extent, or you need to hire an outside admin. But also you're you know if you go into a margin call, you need to put in more money. In the other wrappers, you're capped to whatever you invested. So you need to put, a lot more. You invest 100%, but at least you 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 you're limited in your losses. Where the pure managed account, you're not limited in your loss. So okay. you might have you might have a cost difference between a fund and then a managed account, but at least you have that benefit, which is a hard stop loss. The If you go with the managed account platform, and there are, you have the humongous ones like an Intercap, and then you have the independent ones like Galaxy, like Terras, and then you have the bank ones like a DB Select, for example. There, the good thing is generally the leverage that you can that you can get is they will basically manage more, the margin to give you a three times, a two or three times version depending on your program. So it allows you to have the leverage, but again, having a hard stop loss, and they manage that for you. And they generally allow you to switch from one cell to another very easily at a minimal cost. Honestly, I think right now, having as a manager, your fund on a managed account platform is all you should do. There's no need to have your own fund outside of that. I think having, a managed account platform that can give you, a one time, two time, three time share class is I think a big benefit. Then you have the 40 Ag, very retail. Great, but I think you're right. It's a bit cumbersome. And you have the European equivalent, which is the UCITS. Great. You're in a very regulated environment, a lot of risk constraints, which is great, but at the same time, commodities is a big issue. So it's not the most efficient wrapper. Let's put it like this. And so you have two other wrappers. One in Europe that's picking up a little bit, which is a tracker, very easy to build with a bank or an independent provider and stuff like this. And then you have the ETF, and the ETF. The good thing is not everyone can sell you an ETF. So if you're not referenced to one of the big wirehouses, your advisor cannot call you and say you should invest in this ETF. But generally, not all the time, but most of the times, if you pick up the phone and say, I want to be able to buy this ETF, they have to do it. And it's extremely liquid, transparent, and you can trade it, all day long. Cost is fairly low. The key there is, since fees are low, low, managers have a tendency to put a degraded version of their program and keep the more alpha product for higher fee investors, basically, or wrappers from that standpoint. But to get exposure to trend following and managed futures in general, I think it's not a bad way. And by the way, since a lot of the managers are investors are hesitant these days to invest in managed futures and stuff like this, that is an untapped um, part of the market, the retail market, where if you tell a good story, you can raise quite a bit of money. So I'm very bullish on the whole ETF space for managed futures, whether it's systematic or discretionary.
Let's think about it from this point of view. We have like managed futures, not we, managed futures have relatively low Sharpe ratio, let's say 0.3 to 0.5 at best. You add some fees on top of that, you add some fees on top of that, and as a result, what we are left with? Very little, right? And when you add to this the implicit costs imposed by regulation, like UCITS
Mhm,
regulation, for example,
mhm.
you have even less. So what's the point? You are investing in a product with an expected Sharpe ratio, which is practically indistinguishable from zero, for the privilege of having maybe some protection during crisis times, but maybe not, because it strongly depends on the crisis or what kind of crisis this is. For example, trend following managers lost money in April 2025 when the tariffs were announced on the Liberation Day. It was a crisis, yes, I would say so. And nevertheless, trend following managers lost money, and quite significant amount of money at that time. So to me, it seems like this industry relies on relatively low risk-adjusted return investments, and therefore any additional cost, even if it seems to be very small, may affect the returns, and if it may affect the end user, the investor. When a strategy with a Sharpe 1 is put into an ETF, fine, or in UCITS or in 40 Act, that's absolutely fine. But when you're having a strategy with a Sharpe of 0.3, 0.4, it becomes sort of questionable. Don't you think so?
The again, the I think you'll still get some returns, no doubt. Uncorrelated returns, not negatively correlated returns. I think that's important distinction, as you said. Depending on the crisis, it works or it doesn't work. Um, and um, and again, what are the other what are the costs of your other wrappers? Managed account, very often, with a manager, you're going to have, some management and performance fee. And so it's, somewhat going to, you're going to have a cost no matter what. It's more about picking where do you want the cost? An ETF, first, you cap the cost on ETF. So it's not a management fee, it's an expense ratio. And you say, okay, the expense ratio is going to be, 1.5, 1%, and that includes admin and all this. Many of the other wrappers, managers will have higher fees from that standpoint. So fees is an eternal debate in the hedge fund space, and it's not going
It is.
away. In the end, making money is from an active standpoint is not easy, and so there needs to be a price for paying for all that research and stuff like this. um, I'm afraid that if the race goes down to zero in terms of fees in the end, we'll just have a passive industry, whether it's equities, bonds, no matter what, and asset management will be gone, and I think it would be dangerous. um, the You're gonna have fees everywhere. But where I disagree with you is I think that in the end, your uh, even at a low strategy and some fees, managed futures has an expected rate of return, and you make money. You just need it's one part of your portfolio. It's better than buying insurance where you're paying every year. Here, it's uncorrelated. It adds to your portfolio diversification. Um, But there's a lot of complaining in the meantime, and the funny story I always tell is, the French a long time ago had a retail product called FCIMT, which was basically yeah, too many letters, but it was basically, how do you call it? It was basically a French version of a 40 Act or UCITS, if you want. That was only futures. And I remember telling my dad, that was, 15 years ago, to buy some and just keep it. And every year he would come and complain. Until there was one year, which wasn't a crisis year, where he didn't complain. I'm like, "Were you not talking about it?" Say, "Oh yeah, it finally made money and all this." I'm like, "This isn't correlated." That's what you want to do with managed futures. You want to buy, a decent, not too small, decent portion, and forget about it. It's if you start watching your performance every day and stuff like this, you're gonna get out. It's really a strategy where people should be allocated and long term and keep it as, a core, a satellite portion of their portfolio, but where they don't forget to add every time they have marginal dollars, and that is significant enough. Um, so the end correlation, brings some real benefits to your portfolio.
If you are an institutional investor
Mhm,
and you have listened to our episode
mhm.
and you grew interested in the area, you now think, okay, maybe these guys are saying something interesting. Maybe I should look into this.
Mhm.
What would be your starting point?
Your starting point, in terms of education, in terms of getting educated in the market, or
In terms of getting educated, in terms of getting it through the investment committee, in terms of eventually pushing it into production.
the going to people like me that who are willing to take the time to give you the lay of the land in the space. I always think of a few books. The one that Katie Kaminsky and Alex Grezeman wrote, the one that Rishi Narang that you interviewed wrote about the black box, which is it's also about equities and stuff like this, but that gives you, when you're going to look at systematic, is going to be a great book. Really the Market Wizards about more the discretionary guys. It's first getting all that body of knowledge. And I'm missing one. Oh yes, Managed Futures for Institutional Investors. That was written by Galen Burkhardt and Brian Walls. All those books are okay. Let's start with this. The second is you have very good databases of managers that you can get your hands on. The Nelson report at SocGen, IASG has one. There are many databases where you can see the track records, or for that matter, Nelson Hedge actually is a very good database as well. That's where I would start. We get to Linus and say, Linus, I need access to your database, and look at all the managers and start interviewing then and getting to know in the space, and get familiar with the terms. What's margin to equity, what's round term per million, what are the basics of trend following and stuff like this. People should start with this. And again, we're a small industry. We're a small industry in terms of managers. So it's easy to get, in equity land, you got thousands and thousands of equity long short managers. You're never going to get your hands on the whole thing. Managed futures. And on top of that, you can compare, a London-based manager with a New York-based manager. They're trading the same markets, and it's they're trying to achieve the same thing. So on top of that, you can compare them fairly easily. So I think we're an industry where it's pretty easy to, if you want to do the work, to get in and get to know and learn and get savvy about it.
Okay, Tom, thank you very much. It's been a very interesting introduction to managed futures.
I'll just say,
Thank-
my end thing is people need to be more allocated. I think 6% of the hedge fund industry is definitely way too low. Um, and the problem with this industry is people fall in love after the crisis and they forget about it before the next one. Uh, it's time for people to get,
It seems like
more.
you are asking for a crisis.
No, definitely not. But I think that people should, again, it's, when you buy your insurance for your house, you're not hoping that house burns down, but you need it. So, in a positive expected, because again, it's not insurance, it's uncorrelated, which is very different. But I think it brings a lot to people's portfolio, and so I hope we'll get more investors in the space.